Yeah, so if I look at the structure of the market, it started diverging from the previous patterns of 2017 and Bitcoin 2013, which was interesting because they were kind of completely mirroring it, and then it started changing. It's something that I've been suspecting was going to happen because the participants in the space have changed, and everybody in it from the past, when it was purely retail, haven't got their heads around this. So what happens at the end of the year is, firstly, there's the tax stuff that we know, and that's probably usually been the tipping point for crypto after it's had the huge run at the end of the year. But significantly, institutions tend to rebalance portfolios. So they will rebalance to go back to their weighting. Let's say their weighting was 1% or 2%. They will sell down on their position. So that tends to drag into year end. Hedge funds, because they want to get paid, want to close their books, because then that's where their P&L is marked and then they get paid on their performance fees. So there's a lot of incentivization to actually take profits. Now, that's not profits of people who want to be out of the crypto market. It's just driven by investor metrics. So when you come into January, I used to see this in the hedge fund industry. I write about it every year in Global Macro Investor. There's a phenomenon that happens every January, is everybody comes in with a brand new P&L. And they're like, well, what can I do today? Now, we've got a ton of crypto hedge funds, traditional hedge funds in crypto. So those guys are going to come to their desk. They've squared their book. What are they going to do? They're going to buy crypto. So, and the institutions, I mean, I know this because I've had first-hand conversations with so many, is, they spent the whole year getting the approvals, getting the custody, getting their accounts onboarded with whoever it is. And then the next step is, well, our mandates for 2022. So I see a huge amount of mandate from institutions actively putting money into the market. So my guess is there's a lot of people who think that maybe the cycle's topped, maybe it's done. I think it's a temporary phenomenon. It probably absolutely rips, and it may rip from kind of next week when most of the institutional guys have gone home. And we see that often in financial markets, because then what happens is it's very thin liquidity and there's a bit of a panic to get into the positions, and that usually goes through. So I think next year is probably stronger in the first half of the year than anybody imagines, because everyone thinks it should have finished now at the end of the year, because that's previous cycles. And I think that, and I've talked about this before, I think the ETH 2.0 is going to be the big driver of the market this time. And I'm sure it's going to be buy the rumor, sell the fact. Now, I know that people who are locked or staked for ETH2, there's a period of time where they can't sell. But that's like red rag to a bull to every hedge fund or every trader, because I know you're going to have to sell. So I'm just going to force you to sell at the lowest possible price, because there's a lot of sellers. So I have a feeling that it's going to be a buy the rumor, sell the facts. At the moment it's announced, everyone's like, oh, ETH's amazing now. It's going to be a deflationary asset and blah, blah, blah. And the market's going to puke because everyone realizes there's a bunch of people who are locked into the position and can't do anything about it. So that's my mental framework. Could be completely wrong. I think it's stronger first half of the year than anybody imagines. And the structure of these markets change. And then I think it probably suffers a bit. And that would also suffer with probably withdrawal of liquidity from the Fed and others as well. So then you get the double negative, withdrawal of liquidity from markets and this change of structure because of the ETH2, which I think will be a larger driver of the cycle than the Bitcoin halving was.
It's been choppier, basically since March to May, Bitcoin top first, then Ethereum. They really haven't broken out again. So they've been this big kind of sloppy range that goes up and down a lot. And I've been thinking about that because normally at this point in the crypto cycle, you'd have seen mass retail participation and this explosive run. I was expecting it, as was many. Hasn't materialized. Why? Now, is there a structural change in the market? Or is it because crypto is discretionary spending or discretionary investment? And if you've raised prices on people, they have less money, retail participation, to put into crypto. So maybe that's why the flow. So we've not seen the kind of number of new wallets and all of the other metrics follow when we had the recent high. And it makes me think that people don't have money to put in.
That would be a cause. What if it's a symptom? What if they feel insecure and they see it as a risk asset And they
don't
want
see
to...
it as a risk asset because the narrative is like, this is a long-term inflation hedge.
Yeah.
And we'll talk a bit about that because it's not traditional inflation.
Right.
It's actually about central bank debasement. And the central bank debasement is slowing its rate of change because they're tapering, i.e. they're injecting less money each month in. So it's that it reacts to and not to inflation numbers. They're two different things.
Okay, right. That's important to point out because people will see a print like this and say, wait a minute, that's what I'm supposed to hedge against.
Yeah.
That's the wrong type.
And in the end, we're talking about inflation that's running at 6-7% a year. Well, Bitcoin's up 100% and Ethereum's up 500%. So it's more than accommodated. But people think it needs to be tick for tick correlated.
Yeah.
It doesn't work that way.
Yeah.
What it is a long-term method for sidestepping the devaluation of fiat currency, along with, more importantly, a call option in the future of technology and Web3 and all of the new things that are being built.
Yeah.
If you raise prices on people who are already up to here in debt, then what do? You stop consumption.
Right.
So if you stop consumption, what you're doing is baking the cake a potential slowdown later.
Yeah.
So the Fed are tapering the balance sheet. They're talking about, are they going to raise rates? At the same time, where you're beating the consumer over the head with higher prices, that feels to me that 2022 is not going to be the year people expect it to be. I've said for a while, I think it's going to be a lot weaker economically than people realize. And it doesn't help that we've got the new, the new virus mutation that's going on as well. That's also creating this people saying, well, I'm not sure, do I want to travel? It's like my mum, was she going to go, she lives in Spain, she's going to see my sister in the UK. She's like, maybe I won't travel.
Yeah.
And so all of those things together, create more supply chain issues, which means that this inflation stuff could be longer lasting than we thought.
Yeah.
I thought it was going to be more transitory. But if the supply chain issues continue, then that's a problem. But I'm really worried about consumption.